Welcome everybody to the April QOZ Fund II update webinar. I am Michael Episcope, co-CEO of Origin Investments, and I'm here today with David Welk. He's my co-host today. He is Origin's Managing Director of Acquisitions, and he's joining us from Charlotte. Welcome, Dave.
Thank you, Michael, and happy Masters Week for all you golfers out there.
Great. It's always great to have Dave on the show to share his insight and knowledge. He's our boots on the ground in the market, finding deals every day. Today, Dave and I are going to go over the state of the market, talk about the fund overview a little bit, and our pipeline of deals. Again, just as a reminder, this is an update, so this isn't, as educational as it might be on an evergreen webinar. After that, we're going to open it up to questions. We hope to have the presentation 40 to 45 minutes at the most dialed in, and then 15 to 20 minutes on the Q&A. And thank you to everybody who sent in the questions in advance. We're going to start with those, and we got quite a few. And today, we're going to start with the state of the market because this is clearly what's on most people's minds based on the questions that were emailed in advance. And to say things are moving fast in today's market would be an understatement. So let's jump to that slide, state of the market. And what most people are concerned about, and there was a theme here, there are two headwinds, and we are as well, right? One is construction costs, and the other are interest rates. And both of those are inputs into the cost of multifamily real estate, whether you're talking about the construction costs or the financing costs later on, and tremendous volatility in both of these inputs that really make investing more difficult than in a stable, more predictable environment where you might have moves of, 3, 5, 7%. I was actually speaking with a friend of mine the other day who runs a lumber company. And he said, this was yesterday at a meeting I was at, and he said, we are now sending out pricing on lumber, and we're telling them that it has a 24-hour time mark. He said, we used to leave lumber pricing out there for 6, 8, even 12 weeks, and now we need people to accept it within 24 hours. That's how quickly the markets are moving out there. The last time we hosted this webinar in February, I actually looked back, the 10-year was hovering right around 2%. And we were talking about interest rates moving up then because 3 months prior to that, the 10-year was about 1.5%. So even in that short time span, there was about a 30% increase in the 10-year. Today, we've seen another 30% increase from the 2%. Today, I just looked at my phone a little while ago. We hit a high today of 2.66%. It looks like it's going to continue to go higher from there. And higher interest rates, they have an impact in really two areas. One, I already mentioned, financing costs. When the 10-year treasury goes up, debt becomes more expensive. It's that simple, right? It's not always linear. 10-year goes up by 1%. Sometimes financing costs will only go up by 75 or 80 basis points because banks absorb some of that spread. And where it impacts us the most is really in levered yield, because a property, it'll only produce so much cash flow. So we either pay it to the bank or to our investors through a distribution yield. And financing costs today have gone up around 1%, right? Not as much as the 10-year move, because ultimately banks had a floor, but we're way above that floor now. I would say 6 months ago, we could lock in fixed rates at around 3%. Today, that's hovering close to 4%. And the reason why that's important, because in a fund like this, we have about $300 million of equity, and we're going to do a significant amount of development. And when all of our portfolio is stabilized, we're going to have about $1 billion of debt in this portfolio. And so a 1% increase in interest rates on stabilized properties, that costs us about $10 million per year in additional financing costs. The other area that interest rates will eventually impact is cap rates. We haven't seen a huge movement on the private side yet, but do believe this is coming. And we are certainly incorporating higher cap rates into all of our underwriting, but we've always done this in the past. We've always drifted our cap rates in our model and assumed a higher cap rate in the future at exit versus in place today. And this is really part of risk management. And I believe it's a big reason for our outperformance, because the policy itself really weeds out average deals and protects downside. Because if a deal can't withstand a 30, 40, even 50 basis point increase in cap rates where you're still meeting your cost of capital over a 5-year period, it's not worth doing. So we've always been doing that. So even if we do see a drift up here in cap rates, understand that that's already included in our underwriting. If cap rates go down for some reason, that's only added upside that we'll be able to capture. Cap rates are slow to move generally, and they have been resilient to say the least. Over the last 24 months, they've gone, done nothing but gone lower, and certainly we've seen them go low over the last, 8 to 10 years as well. But it's illogical to think that they're going to stay here, that people will continue to buy properties at 3.5 caps and buy at 4%. It's not a good recipe. You don't buy cash flowing properties to pay the bank every month. Keep in mind, though, we are not acquiring already built projects. We are engaging in ground up development in this fund. We are building to a cap rate in the future that's generally between 5% and 5.5%. And that helps us withstand both higher interest rates and higher cap rates in the future. And the 5 and 5.5% is what we call a return on cost. And it's that margin that we're trying to capture between where current cap rates are and where we are ultimately developing to and generating net income at the property. And if the cap rates stay at 3.5 and we can generate a 5.2 future cap rate, that margin is going to be far larger than if cap rates go up to 4, 4.2, 4.3. However, there still is a margin there on the other side. The other headwind we're facing today, I already talked about this a little bit, construction costs. This is something that changes every single day, but we're seeing a general rise in commodity prices, labor costs, land prices. They're all increasing, and projects are 35% more expensive to build today than they were even 18 months ago. They're also taking longer to build. Supply chain issues, we have to deal with those. We'll talk a little bit about more of those in Q&A. Dave can add to that conversation quite a bit. But all of our underwriting assumes these new inputs. And despite these two headwinds, deals still have healthy margin in today's world. Why? Because revenue is the other input, and revenue has outpaced both of these headwinds. Rent growth has exceeded every conceivable forecast in our market over the last 12 to 18 months. In some cases, cities like Tampa, like Phoenix, they've grown north of 20% in a single year. And just to put some simple math around this, our projects are typically 250 units. And when you have rents go up by $300 per unit, let's say our average rent is around $1,700. So if it goes up to $300, which is about a 15 to 20% increase, which has happened in the last year in a lot of markets, that's close to an additional $1 million to the bottom line. And if you cap that at a 4 cap, you're talking about an increase in value anywhere between $20 and $25 million in additional value. And that's why margins are still healthy today when we're looking at a return on cost. Yes, there have been massive cost escalations, but the other side of that, revenue has kept pace like we've never seen today. And it's the great equalizer in today's market. We're not going to see double-digit growth going forward in rents for sure, but it is happening across the Sunbelt markets. This demographic movement that we've seen is really just bringing forward growth that's been happening for decades. The northern states, the Rust Belt cities, have been losing population to your lower tax, your climate-friendly, your business-friendly states where population growth is happening, lifestyle cities of that nature. And that's not going to slow down anytime soon. And the best illustration, when I'm talking about the market here and just looking at the fundamentals and what we have ahead of us, is looking at the public REIT markets as well. And so what you have in front of you is really a juxtaposition of an apartment REIT on the left-hand side, Mid-America apartment communities, and they are basically Sunbelt markets. And then you have on the right-hand side, a home builder. And public markets, the reason why we look at these is because they tend to lead 6 to 18 months. They're ahead of the curve and where the private markets are very slow to react. So even through this entire interest rate increase, the public market has performed quite well. Even today, these REITs are actually up on the day, and they're certainly up on the year. And you can see the difference between the left-hand side, the gains, and the losses in the home builders. Now, the reason why is, fundamentals. First of all, we have a housing shortage in this country, and the housing shortage benefits both apartment REITs and they benefit housing stocks. So what else is going on here? Well, I talked about interest rates being a negative, but in our case, they're also a positive because they drive demand. Where we lose the most renters is that they age out of renting and they actually go and then buy a house. They are the home buyers of the future, and that's how we typically lose them. But the cost to build a home is no different. The inputs are the same. You've got all the same commodity prices, labor prices that have gone up. So home prices have also gone up 30 to 35%, the cost to construct a home in the last 12 to 18 months. But on top of that, mortgage rates have spiked. They are up substantially. And you see that mortgage applications have cratered. So home ownership has actually become unaffordable for millions of people, which ultimately translates into higher demand for rental housing. And you can see that on the right-hand side, the home builder stocks, they've gotten decimated as a result of that. And these stocks are almost inversely correlated because they're going after the same demand segment. And it's really a zero-sum game. Those who are buying, aren't renting, and those who aren't buying are renting. And let me stop there on this slide. I think that, these illustrations, a picture says 1,000 words, and why I wanted to show these together, because it is something we look at. But let me jump into the fund a little bit, and I'll go over the basics of kind of how things are going there. And I'll talk about quickly QOZ benefits. I know we have prospective investors and active, investors in the fund today. And so I'm not going to spend a lot of time here, but really anybody who's investing in the fund today receives two QOZ benefits. They get a tax deferral. So instead of paying your 2021 taxes this year, you don't have to recognize those until 2026, payable in 2027. And the second benefit is if you're in the fund for 10 years and a day, there's tax forgiveness on any gain you have. So you still get those two benefits by investing capital gains into this fund within 180 days of recognizing them. The strategy of QOZ Fund II is a carbon copy of Fund I. It is to develop a portfolio of 10 to 14 Class A properties, geographically diversified in Sun Belt states. Fund's target return is a 10 to 12% IRR and a 2.5 net multiple over 10 years. And, sometimes people ask about the IRR, they're a little shocked. And so, IRR is a time-based metric. And when you go out 10 years, it's going to be very different than when you market a development project over 3, 4, 5 years. These projects will hit the same IRRs over the short time periods. They will be hitting 17, 18, 20%. But when you hold them for a long time, what you're doing is balancing, you're sacrificing IRR for net multiple. So you're actually growing the amount of wealth that you create, but your IRR is going down. And I should tell you, this is a pre-tax and post-tax return because this is essentially a tax-free fund. We do get the advantage of depreciation. You would have to pay any taxable income if we have that, but we don't think that's going to be a problem. There's going to be enough income and expenses in this fund that there will be no income along the way. And you would really have to generate north of a 3.2, 3.25 multiple if you were to invest non-QOZ money over 10 years to generate the same after-tax return. We're targeting a $300 million raise, and we're a little more than 40% of the way there. After about 6 months of fundraising, we opened this fund in October, closed QOZ Fund I in September. And we do get questions about when we are going to close this fund. And it really depends on capital raising velocity. And it's hard to know, but I'll give you my best guess. I think it's somewhere between 6 months and a year. Fourth quarter tends to be our busiest time, the end of the year when you can invest. But, we typically see a lot of demand come in when funds are about 65, 70%, and that last 30% fills up very quickly. But you do have time still today. Anyone who invests in the fund between now and the final closing will acquire units at $10. We're not going to float the NAV for really about another year and a half until all our properties are closer to being vertically constructed. Because right now we have land, we have development costs, we're constructing, but as we get closer to leasing, then we will value those properties. Now, the equalizer for getting in earlier is that investors start earning their preferred return on day one. So they start earning 7% when their capital comes into the fund itself. So I'm going to jump to the next slide just about cash flow. This is another question. It seems like we always get on every webinar. So I'm going to go over this briefly. How much cash flow will the fund generate for you? And our goal is to return around 25% of your invested equity by the end of 2026. And that's important because you have taxes to pay, I have taxes to pay, my partner has taxes to pay. Everybody in this fund will have a tax bill that needs to be recognized in 2026, payable in 2027. So our estimate as of today is that we are going to be generating around 25% in proceeds for you to be able to pay those taxes. And the reason for that is it takes about 3 years to develop a property, to stabilize it, and then refinance those assets. And that is the source of the money that we're going to be returning is refinancing. And so all of that capital will be returned tax-free, whether we send it back to you in 2025, 2026, or 2027. By late 2026, actually late 2025, early 2026, we estimate that the portfolio will be fully stabilized and generating around a 6 to 8% annualized yield per year. Going back to what I was talking about before, with the rise in interest rates, that is going to fluctuate. If we're financing at 5%, that's going to go lower. If we're financing at 3%, that's going to go higher. At 4%, this is probably the yield or close to it that we will be able to deliver to investors. The last slide I am going to cover is our seed deals here. And I'm going to just talk about this briefly before I hand it over. Oh, there goes my camera for a second. We already have 6 deals tied up, and these are in some stage of due diligence for this fund. So this fund is actually very far along, and a lot of this has to do with the activities that we spent for 3 years in Fund 1, looking at the markets, building our funnel, doing everything. So this fund has a tremendous amount of velocity to it, and we're going to be investing capital a lot quicker here than we were in Fund 1 when we started it in the QOZ opportunities. Those 6 deals represent around $200 million in equity. So we've already allocated 75% of the fund's target raise of $300 million. And that doesn't include deals that are in a more nascent pipeline. Those are deals that are fairly imminent. They have an 80%, I would say, chance of closing. And the important thing is that we've been working on these deals for over a year. And what I talked about before about prices going up, land prices, construction prices, labor, well, all of these projects, the land was locked in 2021. So there's no markup. You get the benefit of 2021 land pricing, and that helps offset some of the rise in construction costs, and that's baked into our underwriting as well. And lastly, you can see some of the diversification the fund already has in the Sunbelt markets. We're in Tampa, Phoenix, Charlotte, Atlanta, Nashville. And to us, market selection is incredibly important, especially when you're holding long-term. We're going to be in these assets for 10 or more years, and a large part of our return is going to come through market rent growth. And when you think about what's happened in COVID, this was really highlighted during this period. We are in Chicago. We have projects in Chicago, but we aren't investing in this fund here. But when we saw what happened in Phoenix, where we had rent growth that happened at 25%, and then in Chicago, where it happened at 5 or 6%, it kind of illustrates how important market selection is over the long term. And that's why we're not in Rust Belt cities, because even though you can develop good generate good development margins in the short run, it's not likely that those cities are going to have higher rent growth over the next 10, 15, 20 years than the ones we are targeting. And when you compound 2% per year versus 4%, it's an enormous difference in wealth creation. And you have to have the wins behind you after this portfolio is stabilized, or in any of the deals that you're looking at as well. So that's why we're in the markets we're in. Real estate performance is highly correlated to population growth, job growth, affordability. And this portfolio is really shaping up to be, quite well, and with some great opportunities that Dave is going to talk about right now. So Dave, handing it off to you.
Thank you, Michael, and good afternoon from Charlotte. As Michael mentioned, I'm going to be focusing at a high level on our overall investment strategy, and we'll be using this map here in Nashville as an example. Some of the markets that we have been targeting as high growth, even before we really launched our investment into the opportunity zone space. And then we're going to dive into some of the specific seed deals that Michael just covered in the previous slide, notably the Edge Hill Commons project in Nashville, then to Elon Rio Grande, which is in Colorado Springs, and then our newest opportunity, which is here in Charlotte, called Eastland Lofts. So I think this map here on the screen does a really great job of highlighting the submarkets within Nashville that were put into the opportunity zone mapping. And the way we came across, just to kind of back up and talk about how we came across the opportunity zone strategy to begin with, it actually came about on a pursuit of an opportunity here in Charlotte in 2018. So I was actually looking at an adaptive reuse project here in an up and coming submarket, actually semi-established submarket called Noda. And when we were looking at the land parcel, we uncovered that it was part of the mapping for the opportunity zone designations. And I have been spending the last really 2 to 3 years looking at opportunities in Noda, seeing that it tracked the path of growth. There was already organic development that was occurring as a result of underlying market fundamentals and demand. And we really started digging into and understanding, not only in Charlotte, where are the other opportunity zones located, but really, taking this and overlaying it across our entire, not only our portfolio at the time, but really overlaying our pipeline of activity. And what we found when overlaying our pipeline with the OZ maps throughout our mostly Sunbelt at the time, and then mountain regions, is that our discipline and target markets that we had identified overlaid almost perfectly with the OZ map and delineation. So we really went in and started focusing specifically in each of our markets, and we went block by block within these specific maps. And in Nashville, again, if you look at where this is located, you can see almost in every single direction around the urban core, there's located an opportunity zone map. And what has happened in terms of how the OZ maps were originally conceived of, they were based upon 2010 census data. So if you think about what has happened in our, again, mostly Sunbelt and mountain high growth markets over the last decade plus, is you've seen a tremendous amount of gentrification and growth in each one of these markets. And it usually stems from the urban core and moves outwardly. So again, here using Nashville, and as you can see on this map, you can see where the dot is for the Edge Hill Commons project. This is located on the southern edge of the downtown urban core of Nashville, just on the other side of I-40/65 from what is known as the Gulch. And the Gulch has seen some of the most, and frankly, across the country, but certainly here in the Southeast, some of the highest growth in terms of its vertical development that we again track in the entire country. So it's been a host of high-rise multifamily, a part of office. You've seen the Nashville Yards project come to completion in its initial phases, which is, we'll highlight here in a second as we go through Edge Hill Commons. But you've seen tremendous amount of growth in the Gulch. Our site sits on just the other side of 40 and 65. And the designation for the OZ here in this Edge Hill neighborhood was based again on 2010 census data. If you look back to 2021, which is starting to capture more of this gentrification, every single year that we get ACS data, we can look and see what the underlying increase has been in incomes, but 2021 for this specific submarket within Nashville, the reported area median income was $67,000 annually. The average income, which is, we're going to see it in all of our OZs, we see a larger dispersion between the median and the average, because you have certainly outliers. As gentrification occurs, you're going to see wealthier folks that move into an area and push up that average. The average income is $97,000. So again, 67 for median, 97 for the average. If you look back to 2010, when this census tract was put in, or the information that was used to put the census tract into the opportunity zone, it was roughly half of those metrics. So tremendous amount of growth in gentrification that has occurred over that last decade. So as you can see on the map too here, we've got other areas within Nashville that are exploding in terms of growth. If you look to the east, just across the Cumberland River in eastern Nashville, there's a number of micro markets within there that we're tracking pretty closely. So there's neighborhoods of Edgefield and Lockland Springs and Five Points that we're looking at, also are very ripe for additional OZ development. So we are quite excited to jump into the next slide for the Edge Hill Commons project, going a little bit deeper into the specific location within Nashville. And as I mentioned before, we strongly view that this is one of the desirable opportunity zone sites that we've come across in the country. And we're planning to develop here 730 units over 5 buildings, again, located just outside the Gulch in the urban core of Nashville. And this project will really serve as the entryway and gateway into Nashville as folks arrive into downtown from I-40 and 65. And future phases of this project will include some urban green space, some retail, and some Class A office, of which the fund not necessarily will be a part of, but will benefit from those uses being located on site. And as I mentioned before, this site is located in proximate to and walkable to Amazon's new regional headquarters. In addition to that, we've got a host of other employment hubs, retail dining, and a number of neighborhood amenities that are located in the Greater Nashville Yards project. And just as a note, in terms of who our partner is on this project, it's a partner called Marquette Companies, who we've done their second OZ development project with. We previously partnered with them on a project in Houston in Fund I. But it's a great story here in terms of how this site came about. Again, why we're so excited about it. And we believe we have a significant edge in our overall land basis. But this was sourced in an off-market fashion by our partners at Marquette. And one of the partners there was an undergraduate at Vanderbilt and actually knew the family that owned this particular parcel and was able to structure an opportunity to buy the site before it even went to the broader market. So again, relationships matter. And in this case, we were able to pick this up at the early planning stages and get involved in the overall design and development of the project. We do anticipate construction starting in late 2023 for the initial phase of the residential, with the additional phases to occur slightly thereafter. We'll jump to the next slide and talk about Elon Rio Grande. So this is an opportunity that's located in downtown Colorado Springs. And for those of you that are Fund I investors, you should be quite familiar with our affinity for the Springs as a market. This will mark our third development opportunity in downtown Colorado Springs. In addition to the underlying strength of the demographics and the drafting off of the Denver Metro, one of the things that we really like about the opportunity zone delineation here in the Springs is that you get this double benefit here of having the TIF associated with a number, well, all of our projects, but a few others will be granted the same TIF benefit as well. But what that means is that you're going to get the OZ benefit from a personal taxation standpoint, but at the property level, all of these projects, and Elon Rio Grande will be the beneficiary of this as well, will benefit from a 15-year TIF, which is a break on up to 65% of the tax bill that would be otherwise due project. So again, huge benefit for us and our investors in that we get the benefit of a big break in taxes. And given the OZ timeline for the whole period, 10 plus years, which is pretty unique. Again, a lot of times, I mean, this is not the first TIF we've ever received in any of our projects before, but generally speaking, in a merchant build platform, you'll get maybe a couple, 3 years of the benefit in a 5-year hold, because usually the benefit comes into play shortly after the project's put into service. You might only enjoy a couple of years. Here, we're going to get to enjoy the lion's share or potentially even the entire full 15-year benefit of the TIF. Specific to this project, this is going to be a roughly 207 unit project. This is again, our third development partnership with Greystar, a market leading or nation leading development platform, vertically integrated with construction and also management as well. So this is located walkable and proximate to Fund I's investment in the Ensley. And there's a lot of great benefits that are occurring to the gentrification in overall downtown Colorado Springs. One of the things that we'll highlight, in addition to being the home of the U.S. Olympic Training Center, is that there's the city of Colorado Springs has recently completed the construction for their new MLS team, the Colorado Switchbacks, which is going to bring a lot of excitement in terms of on game day, 8,000 people for the games, up to 15,000 people for various outdoor events. That's going to be a catalytic transformer for downtown Springs. So we'll jump onto the Lofts at Eastland project here, which is the last one that I'll cover. And actually the newest project that has been added to the portfolio really in about the last week that we've come to terms on this opportunity. This is one that's near and dear to my heart, given that it's located here in Charlotte. And this also represents a second partnership with another partner of ours that we've completing an OZ project in Fund I, which is Charlotte-based Crosland Southeast. So the Fund I investment that we are partnering with them on is called District West down in Orlando. So this particular project is roughly going to be 269 units. We're finalizing the designs on this right now, but it'll be a Class A structured park multifamily investment. It represents what'll be the first phase in a multi-phase master redevelopment of what was formerly known as the Eastland Mall site here in Charlotte. And the Eastland Mall site was a 69-acre former mall that was acquired by the city of Charlotte in 2012. So this has been a project that has long been on the city's radar in terms of it serving as a catalytic project to spur additional growth here outside of the Plaza Midwood neighborhood, located here in East Charlotte. So Crosland, our partner, has been working on this the master development since 2018. And they've spent a lot of time working with a number of constituents in the marketplace, certainly with the city to secure a number of economic incentives. And that's one of the things to highlight here is that in addition to the discussion that we just had on the Elon project, a number of public incentives that are being provided here in terms of a very attractive land basis that we'll be acquiring this at from the city. The city is also going to be reimbursing for a number of infrastructure projects via a TIF structure. So again, a common theme here for these first couple deals that we're highlighting, which will produce some very strong economic returns for the overall project. One thing I'd like to note here that is going to be fairly catalytic in terms of creating place of this project is that 22 acres of this overall master plan will be dedicated to a youth soccer program that'll be run in a co-run, frankly, by the city and the county, and also Tepper Sports Management, which is the owner of the MLS team here in Charlotte. So this will be a great advantage for residents when they'll have immediate access to, again, a 22-acre soccer facility. But in addition to that, as part of the overall master plan, there'll be upwards of 240,000 square feet of office space and almost 100,000 square feet of retail located on site. So drawing in a number of different uses to this location will create some really compelling place for the residents over time. We anticipate construction occurring on this project really towards the end of this year. We're again just finishing up designs and negotiating our general negotiating pricing with our general contractor. So I think that's it in terms of covering the specific deals. Michael, I will kick it back to you from here.
All right, great job. And we'll open it up for Q&A. But before we do, I want to share the puppet, because you said I wasn't going to bring this on live webinar, but here it is. And this is my my puppet. And apparently this is what you buy somebody when they have a no need for a lot. And I got this as a Christmas present a couple of years ago. So I always joke with the team, sometime I come on with this just to lighten things up a little bit. And I don't think Dave believed that I was going to bring it on today, but here he is. All right.
I love it.
Figure that would lighten it up a little bit. A lot of information there. All right, let's jump into Q&A now. Dave, I'm going to give you this one so you can tee it up, because I think this is really important. How are you managing the challenging supply chain environment and rising interest rates?
Great question. Lots to unpack. It's kind of a two-part question, because the supply chain, although there's some linking between the two, the supply chain, I'll take that one first. And, we're not immune. This is a global interrelated issue that we have. And I'll say that specifically some of the things that we're doing with our general contractors is we're not taking this approach that we have to buy everything out immediately. And so we're providing a number of incentives to them. We're setting a budget, and we're establishing it and saying, here's what we're forecasting, here's where we're allocating for, a certain component of the overall construction project. And we will give you additional incentives to buy this out more quickly, to come up with creative ways to store materials on site. We're having regular meetings with our general contractors to figure out changing lead times. And the lead times are admittedly changing by the week and the month. So the lead time for roofing materials, for example, or appliances and other elements in the construction project have continued to vacillate up and down and are now upwards of a year. So I would say that we're taking a very proactive approach and creative approach in partnership with our general contracting firms to, again, mitigate as many risks as we can through storage of materials, through opening up our networks, frankly, because we're developing in our pipeline 10,000 units across the country. We have the ability to pull vendors and suppliers from different areas that some of our local GCs may not have access to. So we're doing everything we can to try and mitigate that risk. On the interest rate side of things, also, we're not immune to this, but we're doing some things very proactively here to try and address this issue. And just as of the last, I think it was 3 or 4 weeks ago, we entered into purchasing a number of swaptions for the fund. And we could get pretty granular on what this means and why this is an important strategy. But I think the soundbite and takeaway from what we did is we hedged away about 35% away of the risk in future rises of interest rates for the entire portfolio, which is pretty impressive, because the benefit of swaptions is that you can do this when you don't have an underlying loan to swap. So we know we have a development pipeline that's large and growing, and we have commitments for the fund. And typically what you would do if you had a project that was under construction, you could enter into what's called a swap. So you have a loan that's associated with a project, and you can put a fixed rate loan in place. Well, what happens with the number of projects that are in development under construction that you don't, or sorry, before they're under construction, that you don't have an underlying loan to tie to? Well, you can enter into swaptions. And we've done that again on about 35% of the entire debt portfolio of future construction. And what we've done is we've created an opportunity where if the underlying 10-year treasury goes above 3%, we'll get paid basically contractually from our underlying swap positions. So it's a great hedge. It's 10 years in duration. And then for future projects, when we bring them online and we have an underlying loan, we will swap out that debt and put fixed rate permanent debt in place.
Thank you, Dave. I don't have anything to add there. So I'm going to take this question again. This was one that was emailed in prior. We will get to the questions that are being asked live as well. And then a lot of these understand that they sort of overlap one another. This one is, can you please speak about the projections in the QOZ fund and how they have changed, if at all? We have not updated our projections. And I will tell you, like trying to project something 10 years out is incredibly challenging. And I don't want to say take it with a grain of salt. You shouldn't do that. We spent a lot of time really evaluating, looking at this, making sure that we are diligently using variables that make sense to us. And so, but the further you go out into time, the more variance you are going to have about any projection. And I would only tell you, like in a fund like this, if I'm going to, maybe adjust something, it could be down slightly, but it's the outliers that really make a fund. So we're projecting, a 2x multiple in a lot of our deals. Some of these deals might end up with a 4x, a 5x, right? When we've missed on our deals, 80% of the time, because of the way we underwrite and the conservative nature and everything else we do, 80% of the time we've missed to the right side. In other words, we've made more money than we predicted. So I think here, if you want to feel comfortable, I would draw a range around what we have. I think our projections are 2.25 to 2.5. I would say the downside is probably a 1.9 with an upside to around a 3.0, or it could even be higher than that, And so we're looking at a moment in time here, and we have to remember that interest rates could be right back to 1.5%, 2% in a couple of years. We're looking at demand that is incredibly difficult to quantify. Even if interest rates stay up, how does that impact revenue on the other side? And when I was preparing for this webinar and really looking at the impact of interest rates on home builders and rentals and trying to figure out what that meant, it's just like maybe 4% rates are actually a net good thing because of the amount of demand that it brings over into multifamily. So we haven't gone back. I'll just say, caveat that with saying we haven't re-underwritten everything and changed these things. We can sort of drive ourselves crazy by trying to get down to the penny or the nickel or the dime about what a forecast is. In any case, we know it's going to be wrong, but I would rely on sort of that range of outcomes that I just gave you.
Yeah, and the only thing I'll add to that, Michael, is that, and just to get a little bit more granular of what you just said in terms of our underwriting and why we may not need to reforecast anything, is that when we underwrite exit cap rates in all of our models, so we're underwriting the future cap rate, we're not using today's actual market cap rates. We're applying quite a large buffer actually from where we're seeing market trades today. And that was done by design because we're not exactly sure that, we don't believe that these cap rates are sustainable. And so what we've done in our models is we've taken a lot of cases, 75 basis point premium to where we believe the actual cap rate is in the market. And then we're growing it from there. So our models can stand actually upwards of a 20% in some cases repricing of cap rates. And also we're seeing continued rent growth as you highlighted. So we're preparing for this in our underwriting. And that's why I believe also we don't need to reforecast.
What is the average time in queue before assets are deployed? So I think I understand this question, but I'll just, there is no time in the queue, if you will. When you're ready to invest, you can. We actually use what we call a queue in the Income Plus fund, meaning that we call capital when we actually require it. So in this fund though, if you have gains, you need to invest them, you can invest them right away. If the question is about how long are they going to be in the fund before they are invested, today, like there's this constant raise, invest, raise, invest, raise, invest, and we have cash in the fund today. But I would guess that we are going to have all the money invested into deals within about 18 months from today. And so there will always be, in a fund like this, some cash drag because we have to take all of the money at one time. But when you look at that cash drag and the impact to your return over the next 10, 12, 15 years, however long you're going to be in the fund, it's really minimal from that standpoint. Dave, you got any questions you want to take?
Yeah, I'll take this one at the top here, which is at what point are these rent increases unsustainable? Incomes aren't rising as much as inflation. And this is a great question. Although we are seeing unprecedented rises in underlying incomes, certainly in a lot of the white collar sectors, but which those data points haven't quite worked their way through to the ACS data. I mean, this is real time. Some of this is anecdotal. What we're seeing it costs, frankly, to hire folks in the marketplace, and talking to others that are in the corporate environment as well. But the bottom line is, we agree with you that these increases are not sustainable. And in some cases, we're seeing a decade's worth of rent growth in the matter of 12 months. Now, some of this, you can unpack this and say, where do you have the most concern? If you could look at a market like Phoenix, for example, and Phoenix is often used as one of the markets that has seen the highest rent growth in the entire country, upwards of 30% in the last year. But if you look at the average rent in Phoenix and you compare it to Southern California, for example, where a lot of the immigration trends are emerging from Southern California, it's still a very affordable market. In most cases, a lot of folks who are leaving Southern California are seeing significant reduction in rents from what they were paying previously, and their incomes aren't being reduced as a result. So this is why we're focused on the markets that we're focused in. We look at affordability ratio at every segment throughout the evaluation of a project. And we are concerned when affordability ratios really get above the kind of 33% plus or minus range from what is observable. But that's also where we're focused. We're focused on, the average rent in most projects is somewhere in the neighborhood of between $1,400 and $1,800 rents, which has the widest swath of renter pool in the entire country and has some of the best underlying affordability metrics. So we agree with you that this can't continue. We have an AI machine learning tool. We forecast rent growth. I'll tell you that model is suggesting we are going to see moderation next year. It's going to look more like 3 to 4%. And then the crystal ball gets a little hazy from there, but it's not going to continue at 20% year over year.
Yeah, Nola, it's such a good question, because this is something that is sort of perplexed everybody in the real estate world. The old rules, the playbook has changed, that you used to draw a ring of a mile, 3 miles, 5 miles around, and now you almost have to draw a ring 500 miles around, because affordability, when somebody is working in New York and they're taking New York wages to Tampa, that's incredibly affordable to them. And what's happening is people are getting displaced and then moving, to the periphery where they used to be able to afford the core. So things are changing incredibly fast. And, we see it too. It's so difficult in today's market when, you have people moving from hundreds of miles because of the mobility of the workforce like we've never had it. The other, so somebody asked a question, how do investors gain access to investment memos with more detail? You can do that. Just reach out to somebody in investor relations, set up a time for a call, ask them about which deals. We generally don't keep those on our website or circulate those widely because there's proprietary information, but we're happy to share these with you. And the other thing is that people can get inundated with information. Some people want a tremendous amount of information, and some people want just to know the things they want to know. And so it's that balancing act between, those two individuals. But we're happy to give that to you. Just call somebody or contact somebody in investor relations by either emailing them, or if you're an investor, I'm sure you've been paired with somebody in our capital raising department as well.
Michael, I'll go ahead and take a question from Emily regarding SOFR, expected to rise between 100 and 150 basis points in the future. Will I no longer see cap rate compression in the past 5 years? Am I going to see the same yields as I saw going forward as I saw previously? Great question. And that's a very technical and question regarding SOFR. And just to let you know, Emily, we do take the forward curves in all of our models, whether it be SOFR related curves, or if we're assuming that we're going to be refinancing and applying the forward treasury market to that underlying interest rate. All that's baked into our analysis. So we're not going to do anything necessarily in terms of interest rate forecasting that's above the market consensus. But what we do is we add some additional buffer to our spreads for the unknown frankly no different than we add some additional spread in our cap rates. So to answer your question directly, historically, yes, if you had a lower cost basis in the last 3 or 4 years, and you've seen this 20% rent growth, you're seeing some outsized yields. What I would say is what we expect going forward is more mean reversion in terms of what types of yields you're going to see. So we believe, based on our forecasts and our underwriting, we're going to see somewhere in the neighborhood of 6 to 7% annualized yields. And that does take into consideration those increased borrowing costs from SOFR. Cap rates are somewhat irrelevant at the end of the day. Only on your refinance would you be concerned, because we're not selling the asset. So yield is definitely the focus. And we do believe, based on our growth rates for machine learning based growth rates and the underlying borrowing costs, will still generate that kind of 6 to 7% annualized yield going forward.
Here's another question. I'll take it. How will these developments differ from new growth fund developments? There is a bright line. If it's in a QOZ area, it goes into our QOZ fund. If it's non-QOZ, it goes into growth fund. I will tell you, if we did not have a QOZ fund, we would be looking at all of these deals for our growth fund. You would not know the difference between, there's no difference in underwriting between the two. And if you saw any of these projects, and by the way, a lot of people listening today, you probably live near or close or will be visiting one of these cities. Please go by the development site and see for yourself, because a lot of times you scratch your head, you're on, how can this be QOZ? And it's what Dave talked about earlier about Nashville, that the cities have changed dramatically, and these are in the path of growth. And so the criteria that we're looking for Growth Fund 4 is no different than the criteria that we're looking for in the QOZ fund, except for the fact that QOZ has to be within the QOZ map and Growth Fund 4 can be anywhere.
Here's a question from Harry. Can one invest funds that are not capital gains? And if so, do you have the tax advantage if we do the 10-year plus 1 day hold? Michael, do you want to take that one?
Yeah, there's no tax advantage. You can invest non-QOZ capital. I recommend that you go into the Growth Fund 4 because that's for non-capital gains. So you don't get any of the benefits. This program was built to really get capital off the sidelines, for people to actually generate capital gains and then invest in projects. And I'll just answer another question in advance. When it comes to investing in a QOZ fund, you only have to invest the gain. You do not have to also invest the principal itself. So if you put $100,000 into something, you have a $100,000 gain and you sell it, you only have to put that the gain in there. So it's a big advantage even over 1031s, where you have to actually invest both the gain and the principal.
Michael, this is more of a policy question. I don't know if you know the answer to it or not, but it was regarding, do we know if Congress is going to extend the 10% capital gain haircut in OZ fund investments? I don't have any insight on that. I don't know if you're aware of it either.
A little bit of insight. I did a webinar with Ashley Tyson in December, and we talked about this. It doesn't look like they're going to bring back the step up in basis. That was something that was allowed last year, the year before. That has gone away now. What it does look like, though, is that there is enough support in Congress that they're going to likely extend the program. They like what it's done. They like, it obviously has some controversy around it too. Maybe it's not perfect. The next iteration, will probably have some changes to it, minor ones. I would imagine they'll update it to the 2020 census as well. That makes sense to me. But the step up in basis, to my knowledge, is not coming back before 2026. Dave, you see any you want to take?
Very quickly, can one fund invest in another fund? I think is the question by James, and the answer to that is the fund of funds cannot qualify, from my understanding, under OZ regs. So you have to invest directly into the fund itself with capital. So that was an easy one. There was another question to explain the lower IRR, Michael, that you touched on earlier in the presentation. I can take that. IRR, as Michael mentioned before, is a time-based metric. So as you go out further into time, and if you have a 10+ year investment horizon, even though the project is profitable, the IRR diminishes. So I think a 10% IRR over a 10-year period, if not mistaken, Michael, is something like a 2.5 multiple on equity. So that's why you'll see equity multiples grow over time, and IRR diminishes. But that's the reason why. It's a time-based metric. So if you had a solid investment but sold it in 2 years, you're going to generate 24% IRR. That's a great return, but you've only grown your multiple in a fraction.
Yeah, there's a saying, you can't eat IRR. Dave, here's a question for you. I'm going to weave two together. This is from John. What are the typical fees and waterfall structure at the development level and for the fund? And somebody else asks something. The fund only owns a percentage of the deal. Who owns the other part of the deals?
Yes. So I'll take the reverse order in terms of the other part of the deals that are owned are typically our joint venture partners. And we find that that's the best way to invest when there's true alignment and skin in the game with our development partners. So they are co-investing alongside of us. And that could range anywhere from 5% to 25% of the overall equity that's required in the deal. So that's where the additional investments come into play. In terms of the underlying deal level waterfalls, I would say they do there's a range, but there's a pretty tight range in terms of what those look like across all of our deals. But typically, you're going to have a pari passu preferred return between us and our development partner on their capital. Generally, that's going to be somewhere in the neighborhood of a 9% pari passu preferred return. So we both get our money back. We both get a 9% annualized return on it, which again, as I talked about before, in the context of an OZ fund, that could be a long period of time now, and that could really eat at the promote. What we do, and typically in all of our waterfalls, is we provide some level of crystallization whereby we can allow our development partners to exit the deal. And because we can't sell the asset, this is done and effectuated via refinance. So we give them the opportunity to run the waterfall based on that 9% return. And typically that's going to be a 5-year hold. And then there's a series of tiers and increasing distributions based on achieving that tiered waterfall. And typically that is somewhere in the 14-18% range of annual returns, where the distribution will increase to our partners at a disproportionate share. So let's say they put in 10% of the equity, they may get 20% above a 14 and 30% above an 18, as an example. But each deal varies, and we're happy to talk offline with each one of our investors about some of those underlying economics.
Yeah, and I was, the base case, and Dave, I'm sorry if you already said this, I was reading other questions, but it's important to note that the dilution there is 10 to 15 basis points in sort of the base case. And, this really helps us find really high quality deals. And, and a great example is even Edge Hill and Noda, right? Like we're partnering with people. Those deals have huge edges that more than justify that cost. And if we were going to do this just by ourselves, we may not have found Noda, and that doesn't serve you in the best way. And by the way, we do development deals direct as well. So I would say probably 20 to 30% of this fund will be direct. So you're going to have a blended between direct and joint venture deals. This question is from Eric. Can we get 100% of our investment back after the initial development phase, around 4 years, if we don't participate in the subsequent optional phase? Dave, do you want to answer that, or do you want me to?
Please fire away.
Eric, the answer is yes. There's a penalty for getting out earlier. We want people to think about this over 10 years. And the other thing that I would caution you about is that you will be paying the prevailing tax rate at that point in time. So the only benefit you are going to get is the tax deferral. And today, your long-term capital gains are going to be about 24%. They could go up to 30, 35, and that's not going to benefit you. But if you have to get out after that 4 years, you can. Maybe you're asking about optionality. If you want a fund that's shorter dated, that doesn't have a penalty for getting out earlier, yeah, I would look at the Growth Fund 4. That's our market rate development. It has a very short time horizon. You can get out in 4 years, or you can stay in that fund for 20 years.
Michael, I'll take this question from Peter regarding property managers on projects. Are they third party? And if so, will they have equity in the deals? Short answer is in some cases, the property managers are, well, in all cases, the origin, they're third party. You know, we're an asset manager. We do not have a direct management arm. In some cases, our partners are vertically integrated and they do have a property management company. So by virtue of those partners will have equity in the deals if they have their own internal property management. But in most cases, we have true third-party property managers, so that are not related to our developers. We look for best in class in every market that we're in. And if we're not, the reason why we like that in some cases is that if they're not performing, we can remove them in 30 days notice. So I'd say it depends, situational, sometimes yes, sometimes no.
This is from Anonymous. If I invest $100,000 in, the questions are, this gets a little confusing with all the tax questions and the timing and things like that. So I'll answer this one as well. But if I invest $100,000 in gains in the fund, the taxes for that $100,000 come due in around 5 years, payable in 2027. When they are due, can I then take that $100,000 in gains and invest them in a different QOZ funds to defer for another 5 years? It doesn't really work like that. So if you take out your $100,000 after 5 years, you actually have to pay taxes on that. You don't get the tax elimination unless you are in the fund for 10 years and 1 day. And with this fund, we've actually structured it as being somewhat perpetual. It goes to the end of the program. But if you want to get out in 10 years in a day, we will provide liquidity through refinancing, sales, et cetera. And if you want to stay in through the end of the program, you can also do that. And so we're dealing with what we call, 3 types of investors: those who know they want to get out, those who know they want to stay until the end, and those who aren't sure. So there's optionality within this fund.
Michael, I'll go ahead and grab this one from Anonymous as well, but I understand an investment, this is an investment and we expect risk-adjusted returns, but is gentrification the primary purpose of these projects? Is there any consideration to displacement of residents? Good question. I did touch on gentrification as being a theme, areas of focus that we're looking at, but really the gentrification was happening even before the OZ legislation was passed. And that's what we're following on, is the organic gentrification and growth that was happening in these markets. And the OZ effectively is a cherry on top. I will say this, that in a lot of our projects and some of our projects, but in a lot of markets throughout the country, there is a big push to affordability and inclusion of some element of affordability in projects. Now we are looking at that and not necessarily we're required to do it, but we will entertain it when working with the cities if we can get some additional tax benefits. But we are not purposely displacing residents of an area. Again, this is happening in the marketplace, but we are providing housing that we believe is attainable in the widest swath of the demographic, which, as I mentioned before, is roughly the $1,400 to $1,800 rent payer.
Yeah, and that's one of the pieces of controversy about this particular legislation. And I think, candidly, one of the flaws in it as well, that we had the Democrats wanted the legislation for one reason, the Republicans wanted it for another. But you don't solve economic issues by going and building a Class A building in a transitioning neighborhood. There are other ways to do that through affordable housing initiative, tax credits. The government does a good job, but this was never designed in the same way, because for us, we have to make a profit so you can get the tax benefit on the back end. We cannot go into these neighborhoods where we can't make a profit because the government is not supplementing this capital structure like they do with tax credits and other things. So it really forces us to be in the neighborhoods that we've been in, but these transitioning neighborhoods looking to make a profit, et cetera. I will say, though, that the program has been successful in the sense that it's created a tremendous amount of jobs and and has really helped to accelerate some of these neighborhoods forward in some of the cities and make them better. But in many cases, it's not helping the part of the segment, the part of the demographic that maybe the Democrats wanted or thought it would help, and that was, just a general flaw in the underlying design of the program to begin with. And maybe those are something that they'll get right in the next one. Will they pair this with tax credits and allow us to go a little bit deeper in these neighborhoods and rent our projects at $1,200 versus $2,000 a month. This is for you, Dave. I'm going to ask it. When do you expect to lock in construction costs on the 6C deals? Are market construction costs for these deals still within your underwriting given inflation?
I'd have to go deal by deal to kind of talk specifics on when we're going to lock in construction pricing, because they all have a little bit different schedule and timeline from when we break ground. But the most near term, I believe, would be Elon Rio Grande. Some of the other projects are 6 to 9 months out. Notably the Edge Hill and the Sawtell projects are going to be 2023 starts. So there isn't a lot that we can do to mitigate forward construction pricing risk on that, other than the fact that we've implemented and underwritten huge contingencies and escalations in our underwriting. So in those cases, we're looking at upwards of a 1.5% to 2% a month potentially in the underwriting on the escalation contingencies that we've underwritten. But more near-term projects that we're breaking ground on, we're working with our general contractors daily in terms of getting updates on the pricing of materials. We're trying to push as much of that risk off to our general contractors as we can. I mentioned some of the other strategies that we're implementing, which is, giving incentives to our contractors to buy out early or incenting them to store materials off site. So there's a lot of things that we are doing to mitigate those risks, but the biggest way we're accounting for this really is the inflation contingencies that we're underwriting and checking those, again, on a monthly basis on relative to where actual pricing's at.
Thanks, Dave. This question is from Kenny. If the U.S. economy enters into recession in 2023/2024, how would that impact your assumptions? So Dave, I'll start and maybe you can chime in a little bit here. Kenny and everybody, number one, when we were in COVID, just to go back to sort of that, the world, we didn't know what was happening, but when we sat down and we said, okay, how do we, mitigate risk? How do we do? And what we really came to the conclusion is everything we did up until that point, everything we do is about mitigating risk, being in the right cities, using the right amount of leverage, being with the right construction companies, having a good balance sheet. You study the market for decades to understand how do you make money and how you keep from losing money. And I'll say even in this portfolio, using low leverage, not cross-collateralizing debt, being in the right markets, building on time, building quality, the right locations, et cetera. That's how you mitigate risk. And it's very likely, I'm not stepping out here, to think that over the life of this fund, we are going to see 1, 2, 3, maybe even 4 recessions. And even looking at the last recessions in the world, you go back, right? Quality properties, those that were leveraged appropriately, those that were in the right locations, they did well. And that's what I take solace is in this portfolio. How will it impact our assumptions going forward? Our assumptions are always changing, and we're looking forward at growth rates, at things. And every deal has to pencil out given the prevailing economic conditions. We don't have a crystal ball necessarily. I think the Origin Multilytics that Dave was talking about earlier, the predictive analytics, helps us immensely and benefits all of our investors. But that's what I look at is, look, there will be a recession, and being geographically diversified and having the wind at your back, we will be out of that recession and playing offense quicker than most.
Well said. I don't have much to add to that other than, we talked about some of the other strategies that we're doing to mitigate risk through interest rates. And one thing to note is that I mentioned about 35% of the portfolio's interest rate risk has been hedged. But Michael raised a really good point, which is in a recession, we could see rates fall back to 1.5%. So there's an argument to be made. You don't necessarily want to hedge all of your interest rate risk away today. You will probably have another bite at the apple to go lock in rates at some point over the 10-year period if rates do go lower.
Yeah, maybe you want to hedge by buying home builders. Seems to be an inverse correlation. Okay, so this is a question from Alvin. What happens if you do not raise enough capital for a particular project within your desired timeline? Alvin, thank you for your question. It's a great one. And in fact, I'm not concerned about the $200 million that we have in projects whatsoever. I mean, we've been raising long enough and there's enough timeline where we can raise for these projects. I will say though, Dave talked about Sawtell earlier. Sawtell is a massive multi-phase project. And what we've done in the past is instead of putting all of the deal into the fund and over concentrating it into one deal, we bring out sidecars. And we did that in Fund I with the deal in Colorado Springs. We syndicated that in less than 24 hours to our existing investors. And we'll do the same here. So if we have a deal that's too big for the fund, then we will always go out to fund investors first. People outside of the fund generally don't see those deals. We've never, syndicated outside of the fund. And that's what we'll do. And Sawtell, because that's a 5-phase development, it's going to be, multiple years. It's highly likely that we'll do, a lot of that in the fund, but also a lot of it out of the fund, because we know people like funds, but they also like individual deals that they can see, feel, touch, and get their arms around quickly.
Michael, I think we're close to time here, but there was several questions in some form or fashion regarding K1s. Some asking when we can expect delivery of K1s for this fund, other funds. Will we be getting individual K1s for each QOF project? You're the resident tax expert here. I'm gonna kick this one to you, but any updates on timing of delivery for K1s? And then the question regarding, will I get individual K1s for each project?
Yeah, let me start with the last question. And you will not get individual K1s from each and every project, but you will get state by state K1s. But keep in mind that in many of the states that we're in, there's zero tax states. So those, some people, it's gray area, you don't have to file because there's no state taxes due. And then in other states, we do roll those up into a single K1 for that state. And then when we have income in the fund, that will you will have the election to enter into a composite K1 as well. So there's only one instead of many, and then we file those on your behalf as well. So we try to make it as painless as possible as we can. We know that people don't love filing K1s, but we do think that the LLC at this point in time, the partnership structure is the right structure, for what we're doing in QOZ Fund. And for those of you who are waiting on K1s, thank you for your patience. We are working as hard as we can to get those out. I just had a conversation with our controller yesterday, and they're coming this week, next week. So we have a lot of different funds and deals, and I think we've sent out, thousands and thousands of K1s already and thousands more to go. So we appreciate your patience. All right, and Dave, you're right. We are way over. I didn't even realize that. Time flies when you're having fun here. Everybody, thank you for your time. And Dave, thank you for being on today. Your insight is awesome. Really appreciate you co-hosting this with me. And I know you're going to be here on future update webinars as well. The last thing I'll say, yep, thanks. The last thing I'll say to everybody is if you have capital gains and want to be in real estate, I don't think there's a better place to be than in a QOZ fund. And I know there's a lot of, kind of turmoil in the markets today, and there's a lot of risk. And we have to, remember that every point in time, we've been doing this for a long time. If you've been an investor for a long time, there's never been a time where you look at it and like everything looks rosy and things like that. And so the real estate market still has solid fundamentals. And we believe that this is a great opportunity in this fund with seed deals that you can see and touch and feel and invest into today, and a great team with a track record as well. So we really appreciate your investment. If you're an existing investor and if you're a prospective investor, we hope that you choose Origin and to invest in this fund. So thank you very much.